Hello traders, welcome to the 7th module of the Advanced Technical Analysis course, Harmonic Patterns. In this lesson we're going to learn how to spot and how to trade a bearish and bullish butterfly, and what are the rules and the ratios that are in play for us to be able to trade it. Now, the structure of the butterfly was discovered by Bryce Gilmore and it was developed by Scott Carney. The structure includes a mandatory 78.6 retracement of the XA leg at the B point and a 127 to 161.8 retracement of the D point, which is also a retracement of the XA leg. Now here is how a butterfly looks like. Here's a bullish butterfly and here's a bearish butterfly. And as we said before, the 78.6 B point, which is the retracement of the XA leg, must be a 78.6 ratio, and the D point, which is also a retracement of the XA leg, must be a ratio between 127 and 161.8. There are a few other rules that we need to take in consideration before we can actually trade it. The pattern should possess a distinct AB equals C pattern in it. And the AB equals C pattern in it is, of course, the point A, B, C, and D. The difference is that the CD leg, which is this one right here, is an extended leg of the AB wave. This means that even though this is an AB equals CD, the CD is an extended leg to the ratios 161.8 to 261.8. So as you can see, this harmonic pattern is a little bit more extended than the other patterns that we have gone through on this lesson, on this module. And the point D has to converge with the 127 to 161.8 XA retracement and the 161.8 to 261.8 BC extension. So in order for us to have a valid butterfly, the first things we need to do is grab a retracement, and the first retracement must be a 78.6. Then the C wave, which is a retracement of the AB leg, must be between 38.2 and 88.6, and the D leg, the D point must be a retracement between 127 and 161.8 of the XA leg and an extension of 161.8 to 261.8 of the AB leg. So these are the ratios that you need to have in play for you to be able to buy the D point in a bullish butterfly or sell the D point in a bearish butterfly. Now let's go through an example so you can better visualize what we're talking about here. First of all, you need a wave, the first wave, and a retracement. As you can see here, we have the first wave, which is the XA, the X point, and the A point, and we have now a retracement. The first thing we're going to do is we're going to calculate the Fibonacci retracement level that has been hit around these levels. In this case, we have hit the 78.6, so the first rule of the butterfly has been met. We can start to follow this chart to see if we actually have a butterfly completion for us to have an excellent risk to reward buy zone. So the 78.6 retracement is the B point, and in this case price bounces to the upside and hits the 88.6 retracement of the AB leg. This is the second rule that has been met, so we name this high the C point. If price does not bounce to the downside and continues to the upside, we don't have a valid butterfly, so we let it go and we go to the other charts to try and find a new harmonic pattern. Now, in this case, price goes all the way down, taking out the B low and the X low. But most traders might think that this is a complete trend reversal because we have taken the previous lows. But you need to be careful because you need to know that sometimes Fibonacci ratios may get into play to form harmonic patterns and push price up. So in this case, we hit the 127.2 retracement level of the XA leg. Now, for you to understand this, it's easy. If price would have stopped at this low, it would have mean that this point had retraced 100% of the XA move. Because it went below the X point, it retraces more than 100%, so it retraces more than 1 on the Fibonacci ratio scale. And in this case, it had retraced 1.227, and it also has hit an extension of 161.8 of the AB wave. Now, we almost have a completed setup if in fact this area is rejected, and because it's rejected, we call it the D point, and we have a completed butterfly. So now we can go long on a very high risk to reward, well, very low risk to reward ratio and high probability setup. So this is how you play these harmonic patterns. First of all, you need to pick a leg and a retracement, and if one of the mandatory Fibonacci retracement levels are hit, you start to follow price and you start to draw your levels of the next leg and your extension levels to see if in fact the D point converges with the necessary retracement of the XA leg and the necessary extension of the AB move.